The mansion tax. You've heard the term thrown around in UK politics for years, right? But what would it actually look like for property owners? Well, thanks to a really insightful analysis from the experts over at ProTax Accountant, we're going to pull back the curtain and look at the surprising and often hidden consequences of a tax like this. Okay, let's just kick this off with one heck of a number. 250%. No, that's not a typo. That's the staggering average jump in value for high-end London properties just since the early 2000s. Think about that. A massive amount of wealth created, sometimes just from owning the right home at the right time. So here's the big question, especially with the 2025 budget getting closer and closer. What if the government decided to, well, tax that value? As we're about to see, the reality isn't as simple as just collecting money. It could actually warp the property market and create a real maze of hidden costs for homeowners. So here's what we're going to walk through. First, what exactly is a mansion tax? Then we'll look at a really strange phenomenon I'm calling the 1.99 million property. After that, we'll try to navigate the valuation maze, see the wider ripple effects on the market, and, most importantly, talk about how you can prepare for these kinds of changes. All right, let's start with the basics. Before we get into all the weird and wonderful side effects, let's just get a clear picture of what a mansion tax really is. So, at its heart, a mansion tax is an annual bill for owning a high-value home. This is not like stamp duty, which you pay once. Nope. This is a recurring tax, year in, year out. All you really need to know are the two key parts: the threshold, which is the value where the tax kicks in, and the rate, which is the percentage you pay on the value above that line. To make this feel a bit more real, let's cook up a hypothetical for the 2025/26 tax year. Let's say the government sets the threshold at a nice, round £2 million, and the tax rate is 1% on anything over that amount. Seems simple, right? Well, this simple little formula is where all the complexity really begins. Let's imagine a real person. We'll call her Sarah. She's a freelance graphic designer living in Islington. Now, Sarah isn't some billionaire tycoon. She just had the good fortune to buy her home 20 years ago, and now it's valued at £2.5 million. With our hypothetical tax, that first £2 million is safe, but the £500,000 on top, that gets taxed at 1%. Suddenly, Sarah's facing a new £5,000 bill every single year. That's over £400 a month, a huge new cost for someone who might be asset-rich but not necessarily rolling in cash. Now, that direct cost to Sarah is just the tip of the iceberg, and here's where it starts to get really, really interesting. You see, a sharp tax threshold like that doesn't just raise money. It actually changes how people behave, and it can twist the market into some very strange shapes. And look, this isn't just me guessing. This comes from some pretty detailed academic research from Columbia University that looked at this exact thing. What they found is that these tax cliffs give people a massive incentive to do whatever they can to avoid stepping over the edge. And that leads to some, well, predictable but very odd results. This is pretty much what that market warp would look like. You would almost certainly see this huge pileup or bunching of property sales right under the £2 million line, say at 1.99 million. A house that might naturally sell for a bit over $2 million suddenly gets a price cut just to duck under the wire. And just above that threshold, the market basically becomes a ghost town. The tax acts like an invisible wall. And stay with me, because this next bit might surprise you. It's not just about sellers taking a lower price. That same Columbia study found that the friction from the tax can make deals fall apart completely. They call it the unraveling effect. In their study, a 1% tax literally wiped out almost 1% of all transactions. Deals that just, poof, never happened, all because of the tax. Okay, so that bunching effect is fascinating, but it points to an even bigger, more practical headache. How on earth do you know if a property is really worth £1.99 million or £2.01 million? And that, my friends, leads us into the valuation maze, a world of hidden fees, subjective opinions, and, you guessed it, potential fights. Let's go back to Sarah for a second. Her home is valued at $2.5 million. Okay, great, but what? Says who? And more importantly, how would she prove that number to HMRC? You see, for tax, you need a valuation that can stand up to legal scrutiny, and trust me, that's a whole different ballgame. You know, research from the University of Oxford shows there are a few ways to value a property, but none of them are a perfect fit for a tax like this. The most common one is looking at market transactions, what similar houses nearby have sold for. But the challenge is, no two properties are ever truly identical. It's so subjective. Two houses on the same street can sell for wildly different prices, and that subjectivity is a nightmare for tax law. Okay, so here's a little pro tip for you. The legal gold standard that HMRC uses is called open market value. It sounds simple, right? It's just the price a willing buyer and a willing seller agree upon. But here's the catch. In the real world, valuation isn't a single precise number. It's a range. Two perfectly competent valuers could look at the same house and completely legitimately come up with values that are tens of thousands of pounds apart. And all of this uncertainty, it has real costs. For a homeowner like Sarah, it could mean forking out for expensive valuation reports and getting bogged down in long, stressful arguments with HMRC. Suddenly, that £5,000 tax bill is just the beginning of the financial pain. All right, so we've seen how this can hit individual homeowners pretty hard. But now let's zoom out a bit, because all these individual challenges, they create much bigger ripple effects that can slow down and distort the entire property market. A mansion tax doesn't just exist in a little bubble. The uncertainty alone could cause a transaction freeze, where everyone just waits to see what happens. It could make foreign investors think twice, and that affects things like construction jobs. But maybe the biggest thing is what's called lock-in. People like Sarah might become too scared to move, fearing a new, higher valuation and an even bigger tax bill. And that reduces mobility for everyone. Okay, we've laid out a lot of the potential problems and complexities, but this isn't about scaring anyone. It's about being ready. So let's pivot from the problems to the solutions. How can you, as a property owner, actually navigate this kind of uncertain future? The absolute key is to get ahead of the game. First, get a real sense of your property's potential valuation range, not just some online estimate. Second, document everything. Keep records of improvements, local sales, anything and everything that could support your valuation. And third, and this is the most crucial, get professional advice before a policy is even announced. Understanding what you might be liable for is just smart financial planning. So, if you take just one thing away today, let it be this. A mansion tax is so much more complicated than a simple percentage on a spreadsheet. In the real world, it would create predictable market distortions and open up a can of worms when it comes to valuation challenges for hundreds of thousands of otherwise ordinary homeowners. And of course, I do have to say, this is all for general guidance. Everyone's situation is unique, and that's why it is so important to get specific, professional advice that's tailored to you before you make any big financial moves. And for that kind of tailored expert advice on property taxes, especially with the 2025 budget in mind, you can reach out to the very people who helped shape this analysis. The team at ProTax Accountant can be reached on WhatsApp or by phone at 07985-689912, or you can drop them an email at info@protaxaccountant.co.uk. We'll wrap up with a final thought for you to chew on. In a world where property wealth just keeps on growing, the question of how to tax it isn't going away. So the real challenge for any government is this: how can you design a tax policy that's fair without setting off this whole cascade of complex and costly unintended consequences? Something to think about.